welcome to another episode of the Odd Lots podcast. I'm Tracy Alloway.
And I'm Joe Weisenthal.
Joe, did you see the JOLTS number that just came out?
We are recording this May 31st, 2023. I did. Job openings back up. You know, that's the thing. Like, they keep thinking, oh, the labor market's going to cool, it's going to cool. But here we are, over 10 million job openings again.
Right. So job openings far exceeded, I think, any analyst estimate, 10 million openings for the last month. And I guess the question is, the market seems to be of two minds here, right? You have a lot of people who seem to be talking about the inevitability of recession, and yet you have the data that's still coming in stronger than a lot of people are expecting. And of course, you know, those two things are related, because if data keeps coming in stronger than expected, then maybe inflation doesn't start to go down and the Fed has to hike even more, and it pushes the economy into recession. But it does feel like not only is there a lot of doubt at the moment, but we're sort of heading in two possible polar opposite directions.
Well, the thing that I keep coming back to is striking is if you told someone, you know, at the beginning of, January 2022, when rates were at zero, that by spring 2023, we'd be at 5.25 on the Fed funds rate. Everyone's like, oh, the market would have crashed. We'd be in recession, et cetera. And yet here we are with more than 10 million job openings. And something that we've talked a lot about is like, the entire 2010s was sluggish growth. And everyone's like, oh, this is the pickup. This is when inflation is going to come back. And it doesn't. And so far this decade, it feels like, okay, this is finally when inflation is going to roll over. This is when the recession is going to happen, et cetera. And these expectations get kicked forward.
Absolutely. And I'm glad you mentioned interest rates just then. And I mean, the implication is kind of, we've had years of people warning about what's going to happen when interest rates rise. Is it going to lead to an explosion in interest rate costs and things like that? And, we have seen some bankruptcies, but we're still sort of at this inflection point, it feels like. So I'm very pleased to say that we have the perfect guest for this episode. We are going to be speaking with the man, the myth, the legend, Jim Grant, the founder and editor of Grant's Interest Rate Observer and a longtime commentator of financial markets. I've been a fan of his work for many years, so I'm so glad we can finally have him on the show. Jim, thank you for coming
Tracy,
on.
It is lovely to be here. And yes, interest rates are a thing again. I began to doubt the efficacy of my business model.
People are observing. People want interest rates observed.
It is a good time for observation.
Well, maybe that's a good starting place, but how would you characterize the current period in markets versus, the trajectory of history? You've been through and written about many interest rate cycles at this point.
Well, first place, I would call it good copy. Journalistic
This is what we like. It doesn't matter up or down. Just give us some good copy.
Yeah, we don't want peace and quiet. Well, there are so many singular features, and dogmatism has been, I hope, has been expunged from the conversation. It's hard to dogmatize after 2020, 21, and 20, et cetera. What is new and different is, for example, interest rates have gone from nothing to 5+ on the short end of the yield curve. And wouldn't you suppose that the home builders would have taken a big, but instead the home builders are right behind NVIDIA as the stocks, and what you would think that they produced computer chips rather than 2x4s. But the home builders made new highs recently. And you know why? Because rates have kind of put interest rate handcuffs on people who are in possession of one of these sweet mortgages beginning with the numbers 2 or 3 or 4. And I think most of the homeowners now that have loans have something less than 5. So people aren't moving and there's no supply. Oh, I exaggerate slightly. But there's little supply, and the home builders are hot-footing it into that gap, and they are coining money with huge margins and great perplexity all around.
So you're speaking our language like on multiple levels. You mentioned semiconductors with NVIDIA, 2x4s, we talked lumber, we've talked home building. So what does that say then about our efforts to fight inflation? We think of housing as like the ultimate rate sensitive sector. And yet here we have home builders close to all-time highs despite the surge. What does that say about, I don't know, perhaps the Fed's toolkit in fighting this kind of inflation?
Well, the Fed only about 2 weeks ago was propagating it. All the central banks of the world for years and years were bemoaning the fact they could not hit their 2% arbitrary, mind you, the arbitrary a 2% inflation target. And the Fed, as recently as the Jackson Hole speech of 2020, that remote Jackson Hole conference, Chairman Powell said, we are going to search for a flexible inflation target. And if it's too low, we will overshoot and thereby bring the average over the cycles up to more than 2%. Now, it seems to me, that was kicking sand in the face of the fates.
Right.
And so there's a bureaucratic dogmatism in the Fed. They've got these algebraic models. My goodness, how formidable they look on a blackboard, but they don't actually function very well so far as the future is concerned. And the Fed was, in fact, dogmatic through 2021 into 2022, buying mortgages recently, I think, as March 2022. So you ask about their inflation-fighting tools? They're rusty, should we say.
Well, just on that note, walk us through, why haven't the interest rate increases fed into the real economy more? Like, why are you not seeing house prices go down? Why are you not seeing the much anticipated wave of bankruptcies that people were warning about for, many, many years after the 2008 financial crisis?
Well, I think house prices have, in fact, gone down. There's this phrase, existing house prices. That is the ones that are not imaginary. So existing house prices are down. New house prices are down from their peaks, 8-10%, if my memory serves. But the point is well taken, Tracy, that, the phrase, I think, something will break.
Right.
And I am of the view that try as Jay Powell might to emulate Paul Volcker, Mr. Powell is not working with Paul Volcker's economy. It's much more dead, therefore much more fragility. People are head over heels over private credit. They contend that this is a not quite NVIDIA quality breakthrough in history of finance, but it's up there. But the private credit is a manifestation of the imperative to build leverage, whether it's on the federal level or the corporate level, not quite so much recent years on the individual level. So there's a lot of leverage. And I would say, Tracy, that with respect to the paradox of nothing breaking much yet, just be patient. I expected it might.
It's coming.
Yeah.
Where do you see vulnerabilities? You mentioned fragilities. Where are they?
Private equity is one. I think private credit will be shown to be rather oversold as a breakthrough. I don't think it's any such thing.
Why do people think that there's something special about private credit?
Well, I think the story goes that the lenders of private credit are more flexible. They have commitments by their limited partners to supply funds. They are not constrained by banking regulations. They are kind of a new breed, so the story goes. But they are lending to an important extent to software companies, which famously lack GAAP profitability. They are lending to the very same people that the public credit markets are lending to, but they're doing it at a somewhat cheaper rate. They're not doing it on a rated basis. So Moody's is not getting the ratings business it did. I don't know. The whole private credit business sounds to me as if it were the same wine in slightly more presentable bottles.
Just on this topic, there's a line that you wrote many years ago now, and it kind of lives for free in my head. And it's slightly random, but it's basically invaliant, a financialized age has produced a financialized pharma company. And I used to think about that quite a lot in the context of Valiant. Of course, they borrowed a lot from markets cheaply. They bought a lot of companies. They used interesting accounting techniques such as add backs to boost their valuation so that they could keep borrowing. And I wonder how much that type of financialization, in your opinion, is reflected across the market and across the economy, not just a Valiant specific type thing.
Well, I would say that it is rather endemic. I guess we ought to define it. What I mean by it, Tracy, is the finance for the sake of finance, not for the sake of making a better product, but finance for the sake of making money through structure, through fees, and the like. That's financialization. And you see it, again, in private equity. There's this thing called add backs. Add backs are a form of sly manipulation of cost structure. So you do a deal, you buy a company, and you say, we will lever it, meaning we will encumber it with debt to the extent of 6.5 times EBITDA. That's kind of non-GAAP measure of earnings. And the reason it's 6.5 and not 9.5 is because we project savings through the great managerial improvements that private equity invariably introduces to its
synergies everywhere.
Yeah, to its portfolio companies. And don't you know that S&P does an annual add-back study? That's the age in which we live. There is an add-back study from you can wait for it every year, and it shows that most of these promised savings, Tracy, don't be shocked, don't materialize. But the fees surrounding them are paid. So that's an example, one micro example of financialization. So I think it's all over the place.
Since you mentioned NVIDIA twice already, I feel like the NVIDIA chart would make a lot of sense to me in the year 2021 or maybe 2019, during the sort of like ZIRP heyday when we associated low interest rates with booming tech stocks. But here we have the chart. It's not ZIRP anymore. We're at 5.25%, and yet that hasn't extinguished this sort of like animal spirits of the market to pile into some like really hot area because AI is really exciting. What does that say about, some of our assumptions about the relationships between investment and animal spirits and speculation and rates when we see this sort of activity at a time of 5.25 interest rates?
The wonderful thing about financial markets is that we keep on stepping on the same rake. There's in science, progress is cumulative. We stand on the shoulders of giants, but financial history is invariably cyclical and recurrent, which helps a lot if you can recognize patterns. Scott McNealy, who is the CEO of Sun Microsystems, gave the terrific little speech, I guess on Twitter, maybe it was a exasperated and rueful expression. It was kind of a post-mortem of the dot-com bubble, which now is so deep in the historical mists. But Sun was trading then at 10 times earnings. And Mr. McNealy said, what do you have to do?
No, 10 times revenue, right?
Revenue, of course.
Sorry, I didn't mean I just want, but I think it's important to understand.
That's the laugh line.
Yeah.
Darn.
Anyway, sorry.
So what he would have to do, what you have to do to break even with at 10 times revenue. Well, over the course of 10 years, I would have to send you every single dollar. So no more R&D, no more salaries for the employees, no taxes, et cetera. So he went through this exercise and at the end he said, why did you pay 10 times revenues? Okay. NVIDIA is like 35 times revenue. So that's 35 years of that.
No cost, no employees, no CapEx, no R&D, no taxes.
I read somewhere that NVIDIA has introduced AI, which is tantamount, in fact, equal to tantamount, the invention of fire. It's the new fire.
TAM on that's got to be huge.
Yeah.
That's always the warning sign, right? TAM, when people start talking about total addressable market size. I have a slightly personal question, but I've always wondered this. Do you consider yourself more of a journalist or more of a financial analyst?
Journalist.
Journalist? Yeah. And how does that influence
I hired Evan Lorenz. He's the great financial analyst.
He's great. Yeah. He's very good. But how does that inform your own work?
Evan. Well, I started not quite a one-man band. It was never exactly a one-man band. This is our 40th year. But for many a year, there was no Evan. There was often someone to lend a hand. Yeah, there were a lot of help. I have gravitated to journalism, I think, more than the really deep diving financial analysis. I'm interested in history as well. Have read a lot, written some. And
you wrote a book on Bagehot, right?
Yes,
recently.
I did. Yeah. Walter Bagehot is the kind of the muse of contemporary central banking. They invoke his dictum about in a crisis, they will say, the contemporary central bankers will say, lend freely to everybody, which is very much a paraphrase of Bagehot's lend at a high rate against suitable banking collateral to solvent institutions, et cetera.
I just want to say, I thought you must have been exaggerating when you said the 35 times revenue, but you were like, I was like, that cannot be right. It can't be 30x revenue. But no, fiscal year 2024, the estimate for NVIDIA revenue is $40 billion. It's $1 trillion company. And so, yeah, we're basically at...
It looks like a typo. We published it last night, and I say, no, let's can't
Because even like look at fiscal year 2027, currently on the Bloomberg, I find it's only at $77 billion. So even like you go out to 27, you're still like at 15x 2027 or 14x 2027 revenue.
Bloomberg, which can get anyone on the phone, ought to call up Scott McNeely and say, what now?
Let's do that. That's a really good idea. Scott's those earnings calls back in the day were really fun. Yeah. Can I ask a question? You mentioned dogma. You mentioned the Fed's rusty inflation fighting tools, which maybe understandably, because for the previous decade, or really even longer, maybe the impulse was reflation, and why are we missing on the downside, et cetera. What did that period teach you as a historian of financial markets, a student, and someone who's what did the period of 2009 through 2020, in which we had large deficits, we had this exploding size of the Fed's balance sheet, and yet this sort of inability to generate inflation? What was your sort of looking back on that decade? What is it? It
was very humbling for me. What I took away from it is that the inevitable is always certain, but not always punctual. Mm. I look back at some of my work there, and I was rather impatient for the inevitable difficulties and crises attending upon this credit creation jag. I thought certainly it was going to happen Tuesday or so. But so it's like the elapsed time between the first signs of house prices going way above trend on the one hand, and the onset of the housing-related credit difficulties of 2007, 8, and 9. That period of 6 years was approximately 20 years in journalistic time, if you were a little bit too insistent upon. Yeah.
Well, just on this point, let me ask a sort of devil's advocate question, because I had a similar trajectory, sort of. I wouldn't compare myself to you, obviously, but, post 2008, I wrote a lot about excesses in the corporate bond market. And it seemed very clear to me that eventually this would blow up. It didn't really. And, we could argue that maybe the time is coming for some of those excesses to get flushed out of the market. But it does feel like the solution to a lot of financialization is more financialization, or at least it has been so far. So for instance, with corporate bonds, when there was stress in the market, the central bank comes in, props up the corporate bond market through the bond buying program. Why can't that continue forever? And what is the tipping point at which financial solutions to financial problems is no longer viable?
A tipping point was 6 years ago.
That's very specific.
My impatient clock, it was a long time ago, but it did not tip. So why can't it go on for a while? No, there are always, these excesses do crop up. They are met with additional stimulus, intervention, manipulation, and still we go on. Who was it who said there is a deal of ruin in a country? I guess it was Adam Smith. And there's a great deal of ruin, so to speak, in finance and manipulated finance. And one of the singularities of the present time is the American position in international finance. This countries emits the reserve currency, which means that we consume much more than we produce. We finance the difference with dollar bills that only we can lawfully print at a most reasonable price of nothing. And we remit the dollars to our creditors, mainly in Asia, say, and those dollars don't leave the country because they come back in the shape of treasuries and mortgages purchased for the portfolio interests of our creditors. So that is kind of a new thing in the long historical sweep. It's not so new in terms of years, but in terms of phenomena. The reserve currency country being a chronic big debtor. That's kind of a different thing. Reserve currency country living on the kindness of strangers, so to speak. That's not exactly writ. So the more one learns, the less dogmatic one becomes about timing, certainly.
Well, that actually leads to the exact next question, which is, obviously currently today in 2023, there's yet another round of, is the dollar going to lose its global status. But we've been hearing that forever, right? Like we heard that certainly after the great financial crisis. I think, pre-great financial crisis, there was a lot of talk about the euro, and we've talked about it in the show, and who is the model that flashed euros on this is not a new thing. So when you think about timing is really tough with this stuff. Like, does it feel new? Does this moment feel different than past times when people had dollar status anxiety?
Well, some of the rhetoric's the same. That I guess by definition, the excesses are greater. The U.S. international financial position, which is a piece of data that comes out every year about this time, ever shows a deepening deficit between what we own of other countries' securities and businesses versus what they own of our securities and businesses and other securities and public securities. So the deficits deepen. But still, what's the competition? Turkey is mad at us and wants a different currency. Iran, ditto. China and then Russia the same. But I don't see those as strong competitors for an alternative currency. I see gold as a perennial option. Unfortunately, too few people share my enthusiasm for that. I wish perhaps Bloomberg.
It's everyone else who's wrong.
Perhaps Bloomberg could help along those lines as well.
Well, just on this note, we were talking about NVIDIA. When you see markets react like that, what do you think is happening there? What is the thought process of an investor who says, I'm going to buy NVIDIA when it's up 40% in 3 weeks?
Well, I think a couple of things. First of all, again, under the heading of you never know, which I have come to embrace as a sound journalistic and life principle, there is a possibility that this time it is the invention of fire, part 2. So one holds mind share for that. I think more likely is that this is part of the muscle memory of a generation of 0% interest rates and all-you-can-eat credit. The great all-you-can-eat credit buffet table was open for business for 10 years. Interest rates fell from 1981 until a couple of weeks ago. It's called 40 years. So that's a lot of muscle memory.
Yeah.
Central banks have intervened predictably until fairly recently when markets shuttered. Look what happened in 2019. The repo market, this obscure recondite thing, caught a head cold in September, and the Fed resumes QE. Didn't call it QE. It's not QE. Yeah, it was QE. So naturally, people assume that the upside is the side to be on. It takes a true contrarian, almost a bloody-minded contrarianness to butt one's head against that, but it's a living. So why do people do it? Because cyclical memories are short and cycles are recurrent, and B, because it has worked. Quote, that phrase ought to be in quotes.
It's funny you talk about the memory of ZIRP or the memory of 40 years of declining interest rates. Right before you walked in, Tracy and I were talking about the real estate market, and I've sort of been looking at maybe buying a place. And the one thing you always hear from people is rates are high now, but you'll be able to refinance lower in a few years. And every time I hear that, I'm like, that would be nice, but there's no guarantee of mean reversion. And, what were they, 18% in the 1980s?
Right.
Could we go back there?
Yes.
Could I see teens Fed rates in my life?
Yes, you could. There's a property about interest rates that I find intriguing. My interest is not widely shared, but here is my reading of the great question, whether rates are mean reverting. So what characterizes interest rate movements is their generation length, phasing, not necessarily cycles, but there are phases. The interest rates fell for the last quarter of the 19th century, rose for the first 20 years of the 20th, fell from 1920 to 46, rose from 46 to 81, fell from 81 to call it 2021. So at each juncture, there was some mark of excess, some mark of speculative excess, blow off, certainly in 1981, a 20% plus funds rate seemed excessive. A 14% yield in 1984 in long bond when the CPI was printing at 4 or 5. That seemed excessive. 10 percentage points of real yield, that seemed a lot. So I speculate that we are embarked on a long cycle of rising rates. And I say that, first of all, for reasons of pattern recognition. There's no theory behind it, but I observed that in 2020 and 21, some unimaginably large number of debt securities were priced to yield less than nothing. Bloomberg keeps this particular figure. And I bet still, perhaps you could check me on this, I bet still there's like $100 billion of bonds priced to yield less than nothing worldwide. But there were 18 trillion, I think, at the peak. Most extraordinary expression of unqualified bullishness on an asset class because it had the name of bonds, which had been falling in yield, rising in price. So it would not surprise me at all if we were embarked on something resembling a generation-length bear market in bonds, meaning rising yields and falling prices. That would fit the form.
Could you mentioned the idea of embarking on a long cycle of higher rates. Could that happen even with a recession in the States? Because this seems to be the bet that everyone's making, right? That inflation isn't coming down, and so the Fed's going to have to hike, and inevitably that will lead to recession. Well, cuts.
Yeah. Starting in 1958, something strange happened, and people at the time remarked on it, which is that in a recession, prices did not fall or subside. And that marked what proved to be the beginning of the age of inflation. So fast forward to the 70s. 70s is kind of a trite historical marker. It's never going to repeat exactly. But for what it's worth, in the 70s, interest rates did fall and rise as the business cycle changed. But inflation came and rose and subsided in three different phases. It wasn't a straight line. So we could have a recession and rates pull back, and then they resume the rise. So the cycle.
So the long-term path would be upwards in terms of interest rates, but not linearly.
Yeah, for example, from 1946 to 56, the movement up in the long-dated Treasury was 100 basis points, 1%. That was it. Went from 3.5, basically from 2.5 to 3.5 over 10 years. So this is rather glacial. This is kind of geologic. So that's why one can forecast these long cycles especially if one is 76 and a half years old, without any anxiety about being laughed at.
That's true. But to your point, it makes sense. Look, as you mentioned, that 40-year cycle basically through, 2000, whatever. It's not like it was only down. We had up cycles in the 80s and the 90s.
Oh, yes.
Pre-GFC. Yeah. It's just that the long-term trend was lower highs each time. Yeah. And so potentially the idea here is, okay, maybe we do get a cutting cycle in a year, but it's lower lows each time.
Yeah. So what happened? So the rates peaked in 1981. In 1984, there was what the technicians call a retest of those highs in yield. And everyone on Wall Street anyone was on the side of saying that rates will go back up again. And the long bond did go to 14% in 1984 when inflation was less than 5%. So it's, I think one of the least appreciated forces in markets, or factors, as they would say, is simple conditioned behavior or muscle memory.
So just on that note, I was thinking back, I used to have a grandparent who lived through the Great Depression and had food hoarding problems because of this, because she hadn't had a lot of food when she was growing up. And so in her later years, when she had access to food, she would buy a lot of it and store it. Are markets, I'm assuming markets are ill-equipped to deal with this kind of generational shift. You have people, Joe and I certainly, for 40 years have been striving for any sort of return, any sort of yield. We've only recently started earning significant bank interest on our savings accounts.
Isn't it pleasant?
It's so nice. It's lovely being a rentier. Money for nothing.
You could probably make some money if we plugged which online bank you did. But don't do it. We got to get them to pay us. No, I'm not going to. Until they pay us, we're not going to say where we
Right. Hold out for that.
Yeah, exactly. Yeah.
Right. And I'm aware that, the real return is still negative, but it's still nice. But how would you expect markets to adapt to this shift?
Well, if it's slow enough, they could adapt easily. The great shift to higher rates, as I mentioned, it took 10 years to get started. I remember my first job on Wall Street. I just got out of the Navy, and before I went to college, I was a clerk on a Wall Street trading desk, and I came home. And the New York telephone, long-dated sixes, the sexy sixes, they call it. And I told my father, what everyone says, Dad, is that these 6% yields this is something special, and you have to avail yourself. So I'm not sure where the New York telephones were in the year 1981, but they were not at 6%. So you have to pace yourself, but there's often plenty of time to adapt. But, there's opportunities in the non-adaptation. In a great bond bear market, all sorts of strange things happen. For example, call protection goes for free because no one expects rates to go back up again. So you can buy call protection without any premium to the price.
When you look at these long shifts, these multi-decade moves, how much is it about maybe politics or just shifting ideas? And so, I'm thinking like part of the reason I think many people would say we had such a powerful and aggressive fiscal response to the COVID shock was the memory of the weak recovery coming out of 2008, 2009, and this sort of like years of slow growth. So it's like, okay, we're not going to like make this mistake again.
We'll make another one.
We're going to overshoot in a different direction. And so how much of like these, like when you look at sort of like long shifts, and obviously like that Volcker era and some of those ideas, some of the supply side ideas from the early 80s, like those are old memories. Like people forgot it. And now people have different ideas. And now people talk about like state capitalism and public investment. How much do these like long cycles sort of correspond with like essentially ideas that are in vogue? You
have to wonder whether the direction of causation. Richard Russell, who's a marvelous technician and thinker about markets, who is no longer with us, was the author of the epigram, "Markets make opinions." And there's I think there's something to the idea that phases of economic life, whether they be markets or in 9-to-5 world of actually producing things, as it were, that the background music of enterprise kind of conjures ideas. I'm not sure if ideas cause things. Maybe they might. But these ideas are recurrent. I mean, I'm told that generation, what comes after Z? A? I don't know.
I don't know. It's whatever my daughter, I don't know. I got to find out what that is.
They're socialists, apparently. So
that's actually the case.
Reinvent that one again. I don't know. I've given you a very poor answer to an excellent question, Joe.
It's all right.
Well, just on the notion of these long-term cycles maybe starting to shift, it does feel like, previous decades were about sort of lower interest rates. And during those previous decades, we basically built the financial system around the assumption that government bonds are the safest thing out there.
Super safe.
Yeah. Government bonds, the yields don't move around that much. And yet, in the previous year, we have seen big question marks around the safety of government bonds and the stability of yields, which have resulted in a few things breaking. To your earlier point, we saw troubles at the bank, the Fed reporting an accounting loss on its own balance sheet. What does it mean for the financial system as we move into potentially a higher rate environment or a higher vol environment for rates?
I think one of the ideas that has sustained markets over the past, call it generation, is the idea of Federal Reserve competence. The notion that people at the Fed know what they're doing and can make things happen. They are weather makers in finance, and they're responsible for the great moderation. They're responsible earlier for Paul Volcker was responsible. So it started with Paul Volcker and his mastery of the inflation problem, and then go on. So I think that the Fed will be revealed as a bunch of well-intended people who are involved in a kind of pseudoscience, and people will wake up one day and say, I've noticed that my weather app is accurate for a day or two, but out 10 days, I wouldn't bet my dog's life on it. And yet we listen patiently, even reverentially, to the economists at the Fed to talk about what's going to happen next month or next year. They know nothing. I mean, the future is a closed book. There's a screenwriter named Goldman, Butch Cassidy and the Sundance Kid, and others such great. He said, apropos of Hollywood's forecasting ability, nobody knows anything, said William Goldman. Correct, as to the fashion of future. The difference is that the Fed thinks it knows something. It thought it knew something in 2020 when it was going to try a little harder to produce more inflation. It thought it knew something in 2021 by insisting that the problem in front of its eyes was transitory, et cetera. I don't mean to ask too much of them, but I would ask of them the confession that they really don't know. So we will, I think, have that fact, that simple, humble fact, presented to us in a way we can't deny. Not so long ago, I remember it vividly, 1980, 81, when you should have been interested in owning these, they had something called Lions and Tigers. These are the trade names for zero coupon treasury securities, price to yield 12, 13, 14, 15%, internal compounding, no reinvestment risk for 30 years. Seemed like a good investment. However, such was the burden of accumulated loss and the loathing that people felt towards this unrepaying, brutally punitive asset class. It was certificates of confiscation was the phrase that bonds acquired. That was the people hurling anathemas at the bond market and at the Fed. And now, did I mention the Fed's broke? No. It is a hypothetical, theoretical insolvency, but to me, it is a symbolic fact of not a little importance. The only thing that looks more like the Silicon Valley balance sheet than Silicon Valley is the Fed's balance sheet. They earn at 2 and they pay at 5 these days. And every week they lose a little bit more of their capital in the form of a promise to the Treasury to one day make it up.
Right.
People gloss over this, say, the Fed can print money, but it can't print net worth, right? So the Fed's not going to go out of business because it is insolvent, unlike some of its charges, the banks. But the fact that shouldn't the Fed be, shouldn't it be held to the same accounting and regulatory standards as the private banks? Wouldn't that have forestalled the excesses of ZIRP and QE?
It can set its own stress test, right?
Perhaps Jamie Dimon could write a stress test for the Fed.
The ultimate rescue.
I heard myself going off on rather a sermon. I will stop.
No, not at all. I want to actually. It's interesting. You mentioned how if you had bought in at some point in the late 70s or early 80s, some of these long-dated zero-coupon bonds, they would have done fantastically well over some length of time, like some of the greatest investments
Decades.
ever. But you had to deal with those first few years, and maybe you took some serious sustained losses. And I was thinking about your point about contrarianism. This bedevils everyone in the financial industry, the challenge of how do you maintain some sort of out-of-consensus position in a period, especially if you're at there's multiple things, but A, there's the psychological battle of am I wrong? Is the market wrong? C, B, you want to make money, and C, you might if you're managing someone else's money, you might not have a very long leash to lose money. What is sort of your thinking about that process of this might be, you don't know the exact timing of when it's going to work, and reconciling these challenges?
Well, I have some experience in this. Mine is journalists don't get margin calls. Friends of mine who do this for a living, that is to say this, meaning identify something that is not in favor or in phase, research it, gain conviction, and hold it in spite of the scorn and the vitriol of those positioned otherwise. That's the kind of the game. Journalistically, all you have to do is have a hard shell. If you're doing it in real time with real money, you either have to have a very, very loyal base of limited partners or investors, or and be managing your own money. It's hard. I mean, it's wearing. It is not life enhancing. But when it's right, it's really sweet.
Yeah, you get to do the victory laps. Well, Jim, on that happy note, we're going to have to leave it there. But thank you so much for coming on All Thoughts. Really appreciate it.
You are entirely welcome, Tracy. Joe, thank you.
That was incredible. It was such a treat. I really appreciate you coming back on.
A delight. Thank you.
We'll have you back on in 20 years where we'll see what the interest rate cycle is. We'll see what Fed funds and the teams.
Gee, I hope I'll be here.
Likewise.
Joe, that conversation was really fun.
That was a lot of fun. I mean, we've both read Jim's stuff for years. It's always educational, always historically fulfilling. It was great getting to talk in person.
Also, I love that he can just throw out anecdotes like, oh, this one set of bonds from
Well, that's the thing. We could have talked for 3 or 4 hours, about what was it like, buying corporate bonds for AT&T bonds or New York Telephone bonds at 6%. And there's so many stories it would be fun to go down with.
Absolutely. But the point that stood out to me was that muscle memory idea. And I think what's happened is it's not just buy the dip because the Fed's going to do something and save everyone. It's also that I think a lot of people have figured out that momentum is a thing. And even though something looks like a bubble, if you can get out early enough, you can still make money. So instead of running away from bubbles, people kind of run towards them now.
Absolutely. I also just think that, I definitely feel this these days, where it's like the meme stock era, the ZIRP era, the FANG era was so recently that it's like, oh yeah, that's normal. That little dip that we had in 2022 and people shunned tech, that was the aberration. But yeah, you see NVIDIA and AI, you got to go back to that. And then I think this gets back to the rates thing, which is that 5% or a 6% mortgage feels really high to people after 15 years of whatever, but it's not, right? It's not high at all, 6%. And they were much higher throughout the entirety of the 90s, and they were much, much higher throughout entirely the 80s. But, for an entire generation, their entire lives of potentially home buying lives is basically the ZIRP era.
I do wonder if the novelty of earning interest on bank savings is ever going to wear off for me. It's been almost 40 years of not earning anything, and now it's just amazing to get a few percentage points.
I'm so poisoned by the last decade. I can't be bothered to click the buttons to move over for a couple of
Joe, you got to do it.
Yeah, no, you can have my
money for nothing and negative real returns. It's great.
Yeah.
All right. Shall we leave it there?
Let's leave it there.
Okay. This has been another episode of the Odd Lots podcast. I'm Tracy Alloway. You can follow me on Twitter at Tracy Alloway.
And I'm Joe Weisenthal. You can follow me on Twitter at The Stalwart. Follow our producers, Carmen Rodriguez at Carmen Armin and Dashiell Bennett at Dashbot. And check out all of the Bloomberg podcasts under the handle at Podcasts. And for more Odd Lots content, go to Bloomberg.com/oddlots, where we have transcripts, a blog, and a newsletter. And check out the Discord, discord.gg/oddlots. Listeners are in there 24/7 talking about all these episodes and things we talk about. I hang out there a lot. Tracy's in there a lot. It's a lot of fun. Thanks for listening.